Sibanye Stillwater, with the ticker SBSW, is indeed an interesting cyclical and stock in commodities. What we see here is the price development of this company stock over the long term. And at this moment, after a significant decline from an all-time high in 2021, the stock is at a low point. And the price is equal to the level of 2013, 2014, but also 2015 and later 2018 and 2019. What is very interesting about this valuation of the stock is that the upside potential could be extremely high, because in the past 10 years, despite the price level or valuation currently being equivalent to that of 2014, the company has experienced enormous growth, with expansions in various mines, not only in gold, where they were in 2014, but also now moving more towards, for example, lithium. And first of all, for the full picture, I will show that I have also taken a small position in SBSW. We can see that below. I entered a while ago. You see, with just a very small percentage, actually it was 1%. But due to the increase, it has become 1.5%. The return is 20% at the moment, and I have actually entered a few weeks ago around the price level of 4. I don't remember exactly, about 3.6. In any case, it is now at 20%. Just a little while ago, it was slightly higher, namely 30 or even 35%, and has recently dropped a bit. Now you might think, why invest in such a risky cyclical stock? Now, because, and I will demonstrate this to you in this video, the upside potential of Sibanye Stillwater seems very high. While the upside potential that is always present seems manageable, but with cyclical commodity stocks like Sibanye Stillwater, you also have to consider that the loss of money can be 100%, because this is not a strong company with a sustainable competitive advantage. No, it is a company that focuses on multinational mining. And today, and this is very important in the story, the revenue is significantly higher than in 2014, 2013, 2015, or even 2019. And I will keep repeating this to you. This is about a stock that has dropped significantly in recent years. Confidence is extremely low. While this company has always been overvalued in the past 10 years, which seems strange in such an efficient market. In other words, SBSW is currently very undervalued, and I tend to agree with the latter. Why? Simply because of the growth they have experienced. The current revenue distribution is shown here. The majority is in PGM, with a smaller portion in gold. So they also have the upside potential if the gold price continues to rise. And they are currently also working on expansion, which is very important in this story. So in the beginning, they actually started with gold mines, gold extraction, particularly in South Africa. And in recent years, they have actually continuously expanded into PGMs, particularly palladium, but also others such as rhodium. And contemporary, or more recently in green metals and energy solutions, specifically just lithium for batteries. And that also keeps coming back in the story of the annual reports. They have various different mines. The color green represents, in their perspective, greener precious metals, such as lithium. You see many different mining operations around the world, which is why it's a multinational. There is quite a comprehensive description of this company in the annual reports, as well as in the latest quarterly figures and the investors update in October. So take all of this very seriously, as this is a very risky investment, speculative. The only thing at the moment is that the price is so low that the downside potential seems relatively lower, but you have to consider a 100% loss of capital in the worst case scenario, for example, because they have relatively higher debt. But again, the story is that in 2014 they were primarily active in gold mines, and you see here a whole story of the development in various mine expansions. They have acquired quite a few stakes in recent years, buying shares from other mining companies, and continue to do so today. They are currently and actively working on the state-of-the-art, highly advanced lithium production facility known as the Innovative Caliber. And so there are all sorts of other developments happening. Well, the management team is very extensive. Perhaps a bit old as well. You can at least say that it has a senior board, all 60 plus. And the current leadership is somewhat, yes, older, but that means a lot of experience. And once again, they continue to grow, and they refer to this as building a diversified green metals business. Well, I'm not entirely sure about that green, but that is not currently addressed in this analysis. Now, normally I will show you the stock analysis as you are used to from us, the valuation, the growth, the profitability. If you look at that for the stock, then it actually doesn't matter that much. It's not so logical. It makes no sense. For example, you look at the price to sales, that is somewhat lower, but the price to cash flow doesn't seem interesting at all. Actually, the only thing that seems relevant at the moment is the price of book value. I will explain why shortly. The market cap is currently 3.7 billion. The total debt is 2 billion, of which the long-term debt is 1.7 billion. And they have, in the short term, enough cash position, and they also have enough inventory for the short term to cover short-term debts. They have already had long-term debts for a longer period. More on that in a moment. As for good numbers, I think this company is really not interesting at all, but that is often the case with cyclical stocks. You should actually buy when the PE ratios are very high, when it is or even loss-making, and the stock price has dropped significantly, then hoping that you have invested in a company that can strongly benefit from the upward cyclical momentum. And because SBSW is primarily located in that green precious metals area, which is currently being strongly phased out. Just look at the lithium price, for example. I believe that the stock price of SBSW has fallen even more due to that association. Profitability is currently relatively poor. The EBITDA margin is at 8%, which is still okay, but there is a loss of minus 48% in terms of profit margin. But this is related to accounting technicalities, which I will explain a bit more about shortly. But you can see that the 5-week average revenue margin was 26%, and the upside potential is very high when we look at the EPS development that could happen. But this is where the risk lies. It's all potential, more speculative. No one knows for sure. I am not an expert in this business either, so let's be very honest. This is purely for inspiration to show you what interesting characteristics there are about SBSW, but especially that it is volatile, that it is risky, all those things. So make your own decisions. Now, I have already said the price is comparable to that of 2014, 2013, and also 2015. 2018, 2019, I made that clear at the very beginning of the video, and I keep repeating it. Why? You can see that the revenue development at this moment, 6 billion, is significantly higher than in 2013 and 2014. Also significantly higher than in 2015 and at a comparable level to 2019. In 2019, the price was also a bit around this same price level, actually slightly higher. So it's not about the revenue. What is it then? Well, first of all, costs have obviously increased, inflation, this, that, so the gross profit is lower than what you are used to from this company. However, you can see that the development could be high, exponentially high, if there is another upward cycle. What we have seen, for example, after the corona in 2020 and 2021 is a huge boom in revenue growth. Now, the operating expenses, that will also increase a bit, of course, because the company is getting bigger. And as a result, they currently have a very large loss on paper, but very importantly, it should be noted that the depreciation is also included here. So this is also a bit of an accounting matter. As a result, the earnings currently seem to be very low. But if you look at the cash flow analysis, and we see that the net income is actually a loss of minus 0.29 billion. However, if you add depreciation back in and amortization to a lesser extent, along with a bit of asset write-down, then you end up with a positive free cash flow. So the free cash flow of this company, or the cash flow from operations, is still positive. The situation is such, and that is the danger with this company, that the free cash flow, although increasing, is still negative. Why? You take the cash flow from operations, or EBITDA, and you take into account the capital expenditures. Well, SBSW is a very capital intensive company. It also makes a lot of investments, but of course it also has to maintain all those mines. Yes, that all costs money, so it is not a perfect company when it comes to long-term investing. In the style of Warren Buffett, where you invest in non-capital intensive companies. Of course, we all know CS. Candies as an example. So this is a big risk for this company. Also, if you look at the balance sheet, at this moment, there is enough cash position, but the long-term debt is of course not very high, because when you compare it to the e-payment, it all seems manageable, but it is on the high side. And all companies with high debts, if things continue to go poorly for this company in the coming years, then it will obviously have a problem. On the other hand, it is true that you see the development in the years when long-term debts are still simply comparable to, for example, 2017, just to give an example, but it is 16% higher than, for instance, 2014. So it is very difficult to analyze this company properly, and then a valuation is provided by, for example, Morningstar. In this case, he gives a fair value estimate of 9. In other words, a doubling of the current price. But to be completely honest, I have no idea what the intrinsic value of this company is. Because you can simply use discounted cash flow with a terminal weight to calculate. No idea. I think this is also not really useful for this company to do. You just need to look at whether there is short-term upside potential, and if the risk is manageable. Despite all that high debt, I think the risk is manageable for me, at least. Therefore, I have also invested a relatively small amount of 1%, which is not much, but I think the potential could be that the company might triple or even quintuple. And if that is the case, I will also say goodbye at a much higher moment, whether that is next year or in 3 years. I will certainly not hold for the long term. By long term, I mean 10 years or longer. We see here the historical development in relation to what could be considered the fair value price. But this is, of course, very difficult for this type of company. It is interesting, of course, when a cyclical company performs very well and makes a lot of profit, you see that the stock price has risen significantly, which makes the PE ratio appear very low. Beginning investors always make this mistake, thinking, hey, this company is cheap. It has a PE ratio of 6, so I'm paying 6 times the earnings. Yes, that's true, but that is based on a peak of the company and its business results. At this moment, the PE ratio of 20 seems very high for this not-so-great company. However, the earnings per share are also very low at this moment. So we see that the EPS in, for example, 2020 was 3, so $3 per share. And currently, that is $0.25 per share. So simply a return of profits to the level of 2020 means a tenfold increase. This also means that the price could potentially increase tenfold. So it has enormous upside potential. We call this an asymmetric investment, where the downside risk seems to be entirely manageable, and the upside potential seems very high. However, the forecasting from Fastcrafts does not actually work well for cyclical stocks and commodity stocks, because, first of all, that EPS estimation is very difficult to make. 5 analysts have made an attempt, but secondly, it is also difficult to determine what the correct PI ratio will be, for example, by the end of 2026. So let's assume for a moment that the company realizes a huge increase in profits, but not to the level of 2020, but a price to earnings of $1 per earnings of 1. Well, that is about 1/3 of the level of 2020, so that is not excessively high. Now, hypothetically speaking, let's assume this is true, and let's say this is the peak, because after 2026, we assume there will be a decline again. So we actually need to assume a higher PE ratio here. Therefore, we are taking the most cautious scenario in terms of valuation. The prediction is that the EPS will increase from 0.25 to 1, and then you could achieve a potential annual return of 17% per year or 40% in total. For whatever reason, let's assume that the PI ratio remains higher, say 14. Then the potential return is 150 to 180%, or an annual average of 60%. For whatever reason, if you are very lucky and it increases to a PE ratio of 20, then this stock could triple or quadruple, and you could achieve a potentially high return. So, what's important is you need to exit when the trend of the stock, since it is a cyclical stock, starts to decline. So you should actually buy early and sell high. Buy when the company's outlook seems disastrous, but in reality, it can actually rise significantly then. It has fallen by more than 75%. When I bought it some time ago, it had fallen by more than 80%. So I bought somewhere around this price level of 4. So, indeed, at the beginning of September. You also see a buy signal based on the long-term trends. We see that the mass ED is starting to increase and is becoming positive, almost crossing the zero line. The stochastics is also beginning to rise. So, either a horizontal trend begins here, or we are being misled based on technical analysis, and is that temporary point, the peak is declining further here. But given the history of this company, it all seems very questionable to me. I think if you look at the valuation, the book value, but especially regarding the growth potential, if the demand for lithium increases, but also gold and palladium, well, the upside potential just seems very high. Times 2, times 3, who can say? The risk is certainly very high. This is not suitable for beginner investors. Be aware of 100% loss of money. I have still made an attempt to invest 1% of my wealth. So that is relatively very little. Of course, hoping that this analysis is correct and that this company, with their experienced management, can significantly increase in the long term. And suppose he reaches a price level of 2020 or 2021, or maybe even higher, then I will be very willing to sell quickly